Hello, Kip. Hello, hello. Say something, Kip, so I can hear you. Oh shit.
Can you hear me?
Yeah, I can hear you.
You're a little muffled.
Can you hear me? Yeah.
You're a little muffled. Can you hear me?
I can hear you.
You're a little.
There we go. I had the live stream running in the background, so it kept looping through. I can hear you. If you can't hear me.
I can. It's just a little muffled.
Really?
It's not crisp. You know what I mean?
I do know what you mean. Mhm. Let me. Oh wait a minute. Let me see.
Let me see. Camera.
Does that sound better?
Yeah, that
Oh,
sounds normal.
somehow
Yeah,
I think
sounded like you were like underwater or something, and it's
well,
obviously you're not underwater.
no,
So
it is raining in Chicago, but no, not underwater. How are you?
I'm good. How are you doing, man?
Excellent. You're not on the island. I can see.
No, no, it's I just closed it up on the weekend. It's pretty cold over there. I mean, it's really cold.
Actually, I just walked out a little bit ago and 35 degrees and it was rainy and stuff. It's rainy here. It's crazy how that wet just bites right through you.
Yeah. Well, I mean, that's on the island, that's what you get. And then when you have I think the previous time I was on, you see the log, vertical log cabin. When those logs get cold, it's a lot to warm them up.
What's a vertical log cabin?
Yeah, it's
The logs stand up
yeah,
straight.
yeah,
Oh
yeah,
wow.
I'll send you a picture of it. It's easier if you see the picture. It's hard to imagine. But yeah, it's just different. But man, when it gets cold, it gets cold.
Oh, I'm kidding. Yeah. Are you a skier? Do you head up to Whistler?
Yeah, yeah. I go up every year. I've been going up for I don't know since I was 10, maybe.
And is
Yeah,
Whistler
I spent a lot of
your
time up
that's your mountain of choice?
there. Well, there's some really good mountains in the interior. The problem is when the snow is good, the driving's bad. So you don't like you want to go to Revelstoke or Fernie. I mean, the skiing's spectacular, but you got to get there, and it's a 7-8 hour winter drive, and closing highways, and I mean, it's much more difficult. Whistler is just easy.
Hang on just a second. Yes, sir. Hello. Okay. Okay. No worries. I'm about to do my noon show, so I got to hop off of here. Um, but you're booked up for the rest of the day. Maybe tomorrow morning. I'll send you I'll send you a note. Okay. Bye. So Fernie, I actually went to Fernie for my bachelor party 20 years ago, and we went. It was
To
summertime.
ski?
No, to go
Oh,
fly.
in the summer. Yeah,
And I've always been curious about the skiing there because
it's unbelievable.
so
It's
beautiful.
one of the best ski mountains around. It's different than your traditional, mountain where you have chairlifts and then there's a run on the right and a run on the left, and it's all cut out. Fernie, you basically go to the top of the mountain and you figure out your way to the bottom.
Oh wow!
And it's wide open, like off-piste skiing. It's not there's no snow cats making a nice track for you, and you go as far as you want, and then you just plunge through the forest. It's great. It's very different.
We went to a place, my son and I, in the UP of Michigan, like the little finger that sticks out into the peninsula, or in the peninsula that sticks out into Lake Superior. It's called Mount Bohemia, and I'm guessing it's kind of like that. They don't groom. They don't really have any runs. You're just glade skiing. You pull into the parking lot. It says experts only.
That's Fernie.
Yeah, it's pretty old school.
Yeah, Fernie and Revelstoke are the same, where you figure out your way to the bottom. Not a lot of signs.
I have a hard enough time figuring my way to the bottom. Well, the right spot at least. We ski in Colorado at Breckenridge, which is a pretty massive area, and if you get down the wrong run, all of a sudden you're at the bottom of the wrong peak, and then you got to take a bunch of lifts just to get over.
Yeah.
But yes, that's good fun. I just went and got my cortisone shots in the knees for the season this year.
That stuff is absolute magic.
Magic. I've already forgotten that my knees hurt. This was just 3 days ago.
That stuff works. What you need to do is you need to have at least 2 doctors, and that they don't tell each other how many they give you. That's the absolute key move. I had like 9 in my shoulder in like 3 years, and none of the 2 knew the other guy was giving them to me.
Well,
and I don't think it's recommended, but at the time, I needed it.
Oh yeah, for sure. My guy will do it every 3 months, but he encourages me to do the rehab. Right? Try to make yourself better, son.
It's just what I like is when you get the next shot, and you still have the X on your shoulder from the previous one, where the target was. That's not good.
Well, they now have a longer lasting one, supposedly. Goes 3 months, I guess.
Yeah. It works. Stuff is beautiful.
I kind of want it on a drip, just continuous. Right?
Yeah. The only problem is at the end of it, you're not going to have any cartilage left. But in the meantime, you can ski.
Yes. I don't know how much cartilage I have there right now. So
not a lot if you've had 9 shots.
Yeah. So what is QLL Trading?
That is my futures trading company, and those are my children, Quinn, Lauren, and Lachlan.
Ah, got it. Oh, hey, here comes Greg Kuda.
Yeah.
Hello, Greg Kuda.
Best hair in the business.
Oh, he's gonna.
I think November's closing at a premium, and he's probably getting some calls.
I would, yeah, you know what?
That would be my guess.
I took it off my screen, and I was wondering what's going on there. LBS, no. Let's see. Yeah, it's. Oh wow, it just traded 460.
Yeah. So he's probably getting calls from Mills to hit it, and they should be.
460 is the offer, but yeah. Why would you? I really sometimes wonder. People don't like to make money, evidently.
Trust me, I've seen it a million times.
it's kind of fascinating. Hopefully the new contract will get a little different participation.
I mean, the second the funds move over, everyone will, including me.
Yeah, for sure.
It's just right now, I need liquidity, and there is none. But the second they do that, we're all going to do it.
Yeah, of course. And you're right. They don't have much of a choice after May.
Yeah. And I mean, the other thing is, I mean, if you're a multifamily and you can use, in Greg's word, any friggin' stick, you should be covering the next 6 or 9 months because you got your projects in front of you.
Yeah.
And you're not paying any carry. You can't buy wood for 9 months out, but you can buy the futures for 9 months out, and you're not paying for the carry. And if the price of lumber is below this, good for you. But I highly doubt it. I highly doubt it.
If you just look at the risk reward of it as well,
Yeah.
how much downside versus how much upside.
Correct.
And
It's a terrible bet that I'm going to buy at 350 for the rest of 2023 versus I'm going to be paying 650, 700, which is very, very possible. If the inflation thing starts coming down and everyone's on their left foot, that, you know, there's apparently KB Homes is going to go from 65,000 homes to 0, apparently. But if they don't, the price of lumber is not going to be here. It's going to be higher. And so why wouldn't you just take the risk off the table? I mean, the multifamily guy's got a lot of things to worry about. The price of lumber is not one of them. Just take the risk off the table.
You would think. All right, Mr. Kuda, are you
Common
with us
sense
now?
is not that common.
All right, I'm back.
All right. Well, you know what? Then I can change the caption here. Again, we're not going to begin. We are here. This is welcome to Lumber Futures from the Free Seats. I know Greg Kuda has to jump at 12:35, so we're definitely going to fit it all in. We have a special guest with us today, a face you've probably seen before on some of our shows. Kip Fothington is with us with QLL Trading, which is a very cryptic way of saying his 3 kids are running his life trading.
Yeah.
I'm sure Greg and I can appreciate that. But
Yes.
You know what? Let's kick it off, Greg. What do you got?
All right, let's jump in. Let me share my screen here. Let's see here. Share.
There you are.
Got it? Okay.
All right, let's do this.
Yeah, thanks for Kip for jumping on. Yeah, no, we'll start in the usual fashion and then filter into lumber. But you know, I think the big thing week over week is we've had fairly benign CPI, PPI inflationary reports, and they've been big tailwinds for a pretty big rally in equities here since last Thursday. And so you can see kind of the Dow, S&P, and NASDAQ have all moved higher. Crude is moving lower in spite of a weaker dollar here. And then our lumber has kind of gone nowhere fast in the front month. January's come under fund selling pressure. And then the big takeaway here is when you look at 10-year notes, the high water mark was about a 4.33. A week ago, we were just right around a 405. As of this morning, we were in the 380-ish type area. So with these inflationary reports being more friendly that inflation's under control, the market, and whether you believe this or not, I'm highly skeptical, but the market is building in the fact that we're getting closer to terminal Fed fund rate, that the Fed can start slowing, and you're kind of seeing this play out in the markets right now. So when you look at the S&P, we talked about this a week ago, how the market was looking for any reason to get a Santa Claus type rally. A week ago, we were in that 38.50 area. Fast forward to this week, and we've popped all the way as high as 40.50. We had a breakout here, a big reversal, outside reversal breakout day. And so now, the upside objective above this 40.20, 40.30 area is a move up into the 40.90 to 4100 area, to kind of neutralize this and say that this is done. You'll close underneath this bar low, which is a 39.51. So the market's kind of raised its upside objective on equities, not just the S&P, but the Dow and NASDAQ. Life is good again. And so when you kind of move into the dollar and some of the other physical commodities, you've had a big corrective move in the U.S. dollar.
Yeah.
And the really big beneficiary of this has been gold, where gold is really gone from the 16.15 area. It's gotten as high as 17.91 as of this morning. And so when you look at a dollar chart, I know Kip and I were talking about this a little bit this morning. You're in the 105 area after topping out at 114. Again, this is the dollar index. Back in the 105 area, a 62% retracement would take you back into the 102 to 1 area. And that's kind of, I think just looking at the different technicians out there, they're looking for this 102 area as a big line in the sand for the dollar index to hold.
And I mean, that right there is such confirmation that they really think the Fed could be nearing its end. There's no better informed traders out there than currency traders.
Yeah, no, I think, watching, the sterling kind of euro sterling all kind of surge higher here as the dollar falls here. You're definitely seeing it a shift out of the dollar into foreign currencies again. And then so here's a gold chart. Again, gold's had a pretty massive move in a very short amount of time. When you look at a gold chart, you could easily get back up to an 1850 to 1900 area. That'd be a 62% retracement. So there's still plenty of upside potential in physical gold. And then when we look at just commodities, winners and losers, well, here you go. Here's equities, NASDAQ, S&P, Russell, gold. And then you look at some of the foreign currencies in here: Japanese yen, Swiss franc, Australian dollar, British pound, euro. So you've had this massive reversal with the sell-off in the U.S. dollar. And, as far as losers here, well, you are seeing some physical commodities. Here's corn, soybean meal, wheat, nat gas, crude oil, Brent crude. I think Bitcoin speaks for itself, but you are seeing again, U.S. dollar sell-off. Surprisingly, you are seeing it materialize. You would have thought maybe you would have gotten an actual rally in crude oil, but crude seems to be more fixated on Chinese demand than any type of FX stuff right now. Whereas gold is purely a dollar play more than anything else right now. And then when we look at interest rates, again, 10-year Treasury a week ago, we were in that 402 area. Today we're sub 4%, 3.8. So,
and that's such a massive move.
Yeah, it's pretty amazing that when you look at some of these moves we've had since the beginning of the year, if you could have a 0.5% move in interest rates, especially on the short term of the curve over the course of a year, that would be a more normalized, move in itself. But to have these swings, these violent swings that we've had since the beginning of the year, this truly is a bellwether year as far as interest rates and the volatility. And so I know we talked about this literally a week ago, how if you were in the looking at 30-year mortgage rates, these rates literally a week ago were all 7.75 to 7.58. Just look at the change here. 30-year fixed VA is now sub 7%. A 30-year FHA is back down in that 7% area. This was literally 7.55, 7.58 1 week ago. 30-year fixed, and these are again average credit stores. $300,000 loan. So these, you've had a pretty, almost a half a basis point move in 30-year mortgage rates in the last week. So maybe that's a good tailwind for housing here.
Greg, what in a normal market, not when you have the highest increase in history over time. If you have a 3.8 10-year, what's the normal adder for the 30-year fix? Is it
So
1.5-ish or 1.75, somewhere around there?
Yeah, somewhere in that range. When you look at the for the traders out there, the knob spread, notes over bonds, all that is your 10-year versus your 30-year, and yeah, that should be your more normalized spread. Probably in that 1.5 to 2% area. So to have it up over 3%. And I know some of the economists on LinkedIn kind of publicized that a week and a half ago, where they said this is just too wide. You're going to get this reversion. You're either going to get short-term rates snap up into 30 years, or you're going to get this bigger pullback. And again, I think this is just a good reset for the market here. You got too extreme, too fast, so you got to give some of this back here.
And I know that the spread's definitely wider if you're going to issue the mortgage and you're issuing at these interest rate levels, you're pretty much guaranteed it's going to get refinanced sometime in the next 5 to 7 years. So
yeah, absolutely.
You're definitely going to want to get a pound of flesh in your first 5 to 7 years, because it's really not a 30-year mortgage. It's really a 5-year mortgage.
Well, not only that, but when you look at interest rates at these levels, look at interest rate demand. I mean, that's just the mortgage underwriting community has been annihilated here since the spring. So just conceivably, how many less mortgages are you actually writing versus 6 months ago? So yeah, you got to make it up somewhere. So you better believe that you're going to charge maximum dollar, knowing that again, it's going to be refinanced sooner rather than later, and you're writing significantly less loans.
A lot less notes for sure.
Yeah,
Well,
yeah.
The one thing I read was 95% of all mortgages in the US are like the median is around 3.5. So if you're in the refinance department at Morgan Stanley, you're probably out of a job.
Yeah.
You can work from home.
Yeah.
You don't need to come to the office.
People are refinancing at 7.
Well, no, and that's the we know that there's still a housing shortage, but who in their right mind is going to move to refinance at today's current rates? I mean, pretty much you're either being forced to move because of a job change, or to just say that the rates or money doesn't matter. Well, then you're just independently wealthy, where you're probably not even going to get a mortgage to begin with. I mean, outside of that, what's the incentive to move now? It's not very good.
Nope.
So we talked about that Fed fund terminal rate, and I think at the high water mark, this kind of prices out when the Fed, you can see basically into March of 2023 through May of 2023. If you would have looked at this literally a week ago, it was up around 5.25 to 5.5%. So already with these two, like literally one report in CPI, one report in PPI, life is good again, to where you've lowered this by anywhere from 1/2 to 3/4 of a basis from where, kind of the interest rate pundits out there think we're going to ultimately reach Fed funds terminal rate here, which is just pretty insane to have, again, this kind of change within a week. It's you're going to be hard pressed to find instances of this in history. You probably have to go back into the 80s to get these kind of swings. So again, we know that we had CPI last Thursday. Again, this is the amazing thing is that the expectation for CPI on Thursday was 7.9. It came in at 7.7, and you got a $1,200 rally in the Dow Jones. So it's not like, okay, it wasn't forecast at 7.9 and it came in at 4%. It literally came in 0.2% lower, and
but it didn't come in at 10.
Yeah, no, and that's the insanity of, like pump the brakes, where the Fed not only they don't want to see these 0.2 decreases, they want to see legitimately under 7%, under 6%, and all the arrows pointing to significantly lower, where this is a starting point. And look, you have to start somewhere, and you could make the case that, okay, we're done going higher, but I just think the market needs to pump its brakes. That you beat inflation with one CPI, one PPI report, and so then here's CPI. These are core CPI 12-month changes. So you can see services are still hanging in there. Goods are coming. Finally, you could say that you've got probably a 38, just on the fringe of a 50% retracement. So your goods, and maybe this was supply chain driven, but the services aspect is going to be much more difficult to come down, for the simple reason that you're not going to have deflation in wages at this point. People are fighting for those higher wages, and you're not going to rein that back in.
I was explaining inflation to my neighbor on Sunday, and he just wasn't getting it. And I said, look, there was too much money sloshing around. People were more than willing to pay. You look at used car prices, right? And those are some of the things that have come back down. But in the meantime, the prices are still elevated, so people need to get paid more. So I think that services number is going to be the definite sticky one.
And I thought I had, I forgot to add that slide. I thought I had one that just showed what actual CPI, the breakdown. I'll have that for next week. But you could see core, this is core food, energy, and like you look at the food aspect of this, okay, you've topped out, but the food component of this really seems to be pretty sticky. The energy component is less sticky, and we're still at a pretty high metric. Okay, we've topped out, but you got a long way to go. Again, the Fed is telling you they want 3.5% in 2023 for inflation. So you got a long way to rein this back in to where they're targeting. And then I thought this next chart was good. Where is inflation the highest in the U.S.? This kind of speaks for itself. Depending on where you at, you probably either agree or disagree. You certainly have the highest probably energy costs here. And then, what's the rationale here in Texas?
I would say it's migration.
That's a good point.
When people move to an area, the area doesn't just all of a sudden, hey, we've got all this excess capacity to provide these services or, whatever. So those are the regions, the mountain states, Texas, and the Southeast are where people move to.
Yeah, I know, and that's a great point, Mike, and that you can see, it makes sense on this chart. Phoenix, Atlanta, Miami, although I'm not sure how many people are moving here to Seattle. But it just kind of gives, there's some obvious ones, obviously the West Coast, but, in being in Phoenix for the NALA convention, I can't say that I noticed an exorbitant amount of inflation going out to the restaurants and bars versus anywhere else. And then here's gasoline. So again, we've come off a long way from the highs, but we're still substantially higher than the last 3 years.
I know this falls on deaf ears for Kip, but there's no 380 in Chicago right now. I just filled up at Costco for like $5.50. Some ridiculous amount.
Right. And so, the headlines, So I'm sorry, go ahead.
I was in, had a little trip in Europe, And it's incredible the difference in the price of gasoline / diesel in Europe compared to North America. It's like 3 times as much. And it's funny. There's not a whole lot of pickup trucks in Spain. There's a lot of really small cars with
Yeah, you
little
see it.
four bangers,
Farmers
and
drive
you
small
get
cars and stuff,
500,
really.
600 kilometers on a tank. You don't see a lot of Suburbans over there. It's amazing.
Yeah, isn't that funny how that works?
Yeah, who would have
No,
thought?
it's meeting with some of the Euro mills last week in Phoenix. Just like, well, what are your heating and electrical costs? Year over year, and this was just Germany and Austria, but the average person in Germany and Austria is paying anywhere from 9 to 12 times energy costs. So electrical and gas, year over year. So put that, like imagine paying 9 times what you paid a year ago, or 12 times what you paid a year ago, just to heat your house, and like that just puts it into perspective. What a tough road Europe has here.
Well,
Where
I know
how
what
many people can
I know what
how
the
many
wife and
people
kids.
can afford that?
I know what the wife and kids would be getting for Christmas, which would be a few more sweaters.
Sweaters.
We're going to
Well,
be
and
turning down.
there's a reason the euro is equal to the US dollar right now. There's
Yeah.
a reason for that. And you just pointed it out.
Yeah, no, absolutely. I think it's a race to the bottom to export inflation and spread the misery out. Yeah, 82 might be a little excessive, Matt. I look at it. My wife would be happy though. So the one other headline today is household debt soars at fastest pace in 15 years. As credit card use surges, that's encouraging. Again, you have inflation and sticky inflation in food type items and core type items. Well, unless your wages are meshing up with actual inflation, and the answer is they're not. You've taken, even with the retracement in the latest PPI CPI numbers, your Q3 wage potential, again, this is just an average. You've lost 3.4% in wage growth versus inflation. So wage growth is not keeping pace with inflation. So guess what that leads to? People
Well,
using
we've just
their
figured out the
credit
problem
cards.
here in the United States. It's Matt Beamer.
Yeah. More people need to become lumber traders, right?
Yes.
So again, inflationary expectations. You can kind of see Federal Bank of New York. Kind of where, kind of again, when you average these out, they're collectively looking for 3.5% inflation. Got a long way to go. You've got a, at 7 point something, you still have a long way to go.
Well, to get there, you got to stop going up. So maybe that's the point we're at.
Yeah, well, that's a good point. So the other big one out today, Home Depot posts better than expected quarter despite inflation, and the headline numbers looked really good. But I literally had 2 of my CFOs contact me this morning, and did you actually look at the numbers? And it's funny, Tim Seams, who does a lot of podcasts concerning housing, put this out where he kind of called it out. Look at their inventories year over year, look at their interest expense year over year, look at their free cash flow year over year. I don't know. It's questionable at best. Yeah, they had better earnings, but their forecast moving forward certainly is concerning. Look at their merchandise inventories year over year, and then look at their current assets year over year. Look at their cash year over year. They have 5 billion versus 2.4 billion. Now that's still, I'd like to have 2.4 billion, but that's 50% less than where it was a year ago.
Did they do much buyback? Did they buy back stock or something?
That's a good question, and I know I think their call. I think their call is tomorrow. So that'll be something interesting to listen to see what they're saying. Because that was one of the other big takeaways I got out of NALA and talking to the mills that their big box business has improved. It's probably the best it's been since the spring for whatever that means. There does seem to be good takeaway to the Home Depots, the Lowe's, the Menards, and I heard that from multiple mills. So I thought that was interesting. And then before we jump into lumber, the last housing snippet here, buyers out. No, this is just people buying, selling homes. Buyers outnumber sellers. You still have more buyers than sellers, but we're definitely trending to where you're having to do a little bit more work in selling a home here.
Yeah, and I mean the buyers are there. It's just the prices have moved to a spot where they're not interested anymore, and they're willing to wait it probably.
Yeah. Yep. And so, the other big thing, Thursday, we have housing starts and permits, the forecast for housing starts. Last month, we were 1.439. The consensus is 1.41 to 1.4. It'll be interesting to see if we actually stay above 1.4% with starts. Permits, 1.56. The consensus, I've seen stuff as high as 1.51. This is kind of the low water mark. So you could see a big drop off in building permits, actual building permits with Thursday's numbers here. This is going to be the one. If it's a big, you could see a really big drop in building permits here for October.
I'm going to steal the screen for just a second, as long as we're talking about housing. This is something that's on my radar. China's reopening, and they are very interested in getting that housing situation over there going again. So something I would recommend everyone just keeps an eye on. We know that the appetite for fiber, maybe not in lumber, but logs as well, in China is huge. Kip, what do you think is, being over on the West Coast, what would have to happen in China?
We're starting to see, especially in the low grade, we're starting to see some bids come in. I mean, they're cheap, of course, but you look at 2x4 number 3, for instance, right? It's $250 million. That's duty in. You take the duty out, and you get a bid of $200 US mill to go overseas. That's also causing dumping issues going to the US, right? And we're going to have the inevitable rail problem this winter. Inevitable. So do you want to use those rail cars on number 3 going to, for plate stock down to Atlanta and Texas? Or do you want to use those rail cars or trucks to move it off overseas, even if it's we've seen them sell it at a big discount before, and it kind of gets you out of that dumping. And I think China is going to start. The prices are low. Where we have a big problem with them is when the North American market's humming, and they just simply don't want to pay the price. We're now getting low enough, and with the exchange rates and stuff, I think it's very possible that we start to see them come back to the market in North America. Yeah, we're not that far away now.
And the regime, well, the structure of their government over there is such that if they want to hit the gas pedal, they can hit the gas pedal like today. Greg, you ready to go back on the screen?
Yep. Okay. Let me pull it back up into.
All right, let's get into some lumber.
Yeah. So I mean, again,
sorry, Greg. One thing to add is, like in China, the property market. I mean, everyone's got their stats, ghost cities, all this stuff. It's quite a bit different than here. There is a lot of people that do not want their money in a Chinese bank for obvious reasons, right? A lot of the apartments over there that people buy, they put down 75% cash. So the thought that like a 2008, somebody in Las Vegas owned 6 houses and they're all leveraged, to the hilt, that isn't how it works over there. And so the idea that they're going to have this massive meltdown when you've already put 75% to 100% of the price down is probably highly unlikely.
Yeah, it makes sense. All right, Greg, where are we
Yeah,
at
and
now?
and the other thing I'll add with China is that legitimately, whatever's flowing out of Russia truly is going into the Chinese market, where that was the like that's not going to change. Where again, I think it legitimately has to do with when truly their prime minister decides to flip the switch and turn them back on. I think a lot of this is very intentional to show the world. Again, this is my opinion, but this is to show the world how much you need us. And when they decide that they want to be consumers, demand-driven consumers again, then I think it is more easily to flip that switch than it is in a free market world like ours. Weekly continuation, we literally, I was just checking, November went off at 454.80, up 760. So that was the last trade. So, the sawmill should be able to sell everything now at 454.80 or greater, right? Because that's where November tells us fair market value is. No, I'm kidding. 454.80, you obviously had some people short squeezed out of the market. When you look at the weekly continuation, we're still kind of trading in this narrow coil formation, and we'll kind of get into it. Here's January. Really, to me, you're hoping this market down into the Bollinger Band low of 390. We know that the funds have increased their short position. So any attempt to flush down here, I think, is seen as a buy opportunity by the industry. As far as the upside, really you probably would have to get back above 450, back above the 44-day, 40-day, even the 50-day up in this 480 area to kind of make the funds nervous. But we'll jump back to some of these other charts.
I want to steal the screen one more time because I did this today and this was really fun. This is barchart.com, which I couldn't recommend enough. This is free charting for you. And this is the chart that Greg just had up there. It's a 6-month front month continuation chart. And as we start to kind of slide out, I got to keep this daily nearby. It looks like, hey, man, maybe we're at a bottom here, right? Well, let's move out 5 years. Oh, well, okay, maybe we're kind of at a bottom, but sort of middle of the range. I'm just going to bump out to 20 years. Over the last 20 years, now this is absent of inflation, of course, the price we're at right now would be historic highs, right? So, the thought that we couldn't go lower here is it's just not true. We very, very easily could go lower from here. Or I know Kip is a big proponent of the inflation that has gone into sawmilling. Maybe this is the hard bottom. Maybe this line is where it's supposed to be. But I recommend going over to Bar Chart and playing around with these charts. And just when you think you're all dialed in on what's happening today, you get a little historical perspective.
Yeah. So I think, Mike, this is the ultimate chart. The line, is it the same old lumber and this was just an aberration, what we saw the last 2 years? Or was there this legitimate paradigm shift into we add inflation, we add higher costs? This is a different lumber market where we moved out of that 250, 275, 300 to 4.25, 450. The old way of doing it pre-2018, pre-COVID versus, have we truly changed to where the upside parameters are significantly higher, or at least the average mean price for lumber deserves to be higher? We're going to find out, pure and simple. We'll find out, because right now, when you look at managed money, and going back to hot girls are back, Mike.
Look at that.
See, Kip, you're on the show today, so we got hot girls that are interested.
Oh, nice.
Yeah. But when you look at the CFTC numbers, the funds, conceivably, if they're technicians, if they're looking at historicals or looking at the chart Mike just referenced, yeah, we can go back to 350. We can go back to some pretty extreme numbers and put your money where your mouth is. Well, look at the build and the fun, shorts yet again, where they've come plowing back into this market.
I tell you,
and then look at this, the commercials, the mills. We don't want to be short down here.
This is the number one data point that we have today. If you don't look at this and say, whoa, you're missing out the total market structure. When 2/3 of the short interest is essentially fast money that has no vested interest in the overall market, that is just looking for, financial gain here. When they start to move, it's a snowballing effect. For sure.
And again, I'd like to get Kip's take, but to me, this makes my job 100% easier to see these kind of moves. To know that the funds are back in at the lows, the perceived lows, seasonal lows. Knowing that commercial shorts. Okay, yeah, we can't short cover here, but we know that this can get significantly bigger. To me, this is the critical thing, because what other segment here is going to sell this market on further weakness? Once these guys stop selling, then what? Who's there to take their place? The answer is this is your catalyst at some point to go substantially higher. When they stop selling, this allows for a much bigger float back to the upside.
Yeah, what do you think of that, Kip?
Yeah, I mean, there's a couple things. I mean, clearly the open interest increase has been, them selling again. And I mean, you have to tip your hat to them. They've been selling since 800 or $750. They made a lot of money.
They're not wrong.
And they probably, it's 1% of their entire portfolio, and it's just computers doing it. They probably don't spend a lot of time on it. But the one thing that I'm sort of longer term, and I've said this in a bunch of different ways, but when you have 30 yellow pine mills and you have 30 owners, there is no, there's no coordination there, right? When you have 30 yellow pine mills and there's 2 owners, like there is now, the ability to throttle production up or down is much, much greater. And the reason I say that is there's not been a huge number of announcements in BC or Alberta. I mean, a little bit here, a little bit there. But if you look at the pulp mills, the proof is in the pudding. They like to carry 6 to 8 weeks worth of chips. It's a huge production facility. It's not a sawmill. They're very, very difficult to shut down quickly. It takes a week to shut one of them down. They have like a week's worth in BC. And what that tells you is everybody in BC is curtailing, and it's probably in the neighborhood of 30 to 40%. And I think what you're going to find is on January 1st, people are going to have business in front of them. KB Homes is not going from 65,000 to 0. They're probably going to build a couple of homes, and the inventory to take care of that is going to be much less than people think. Mm-hmm. And you've got this massive, this is a week ago, right? We're at 63% short interest. That's a week ago. Today, what is that?
It could be 70, right?
70%? Yeah, probably. And at year end, they've made a lot of money. At year end, that number is not going to be at 70%. They are going to cash it in one way or the other.
Well, and the other thing is it's not going to be in January. So how are they going to get it over to March? Which leads us to that.
They're either going to roll or get out, and I mean that's what they did in November. They kind of did. I mean, Greg, the numbers better than me, but it kind of seemed like it was half and half.
Yeah, hey Greg, why don't we let you bounce
and half get up?
Let's let you bounce through those next charts so you can get you on your way.
Yeah, am I still sharing here?
Yep.
Okay, so I mean, when you look at January again, I think that you need to get back above the 450. If you were to start to do that, you would take some of the weak-handed funds out. But you can see Bollinger Band high, Bollinger Band low. You're going to start to converge. So, really, you need to get back above 450, 480 to project any hope of 500 to 530 plus. But this is if you fail to break out here, then it becomes very easy to see a breakout, a hard, severe breakout back to the upside. Look, you're either going to float around in a range, but with the funds adding to this position, the way that this works is they have to keep adding to this position. In order to break this market out to the downside, you need that continuous momentum. The second you let up off the throttle, then you can conceivably become the momentum and you could get a very violent move back up into this 480 to 500 area. And it has nothing to do with the fundamentals of lumber. It has everything to do with the commodity funds just saying we want out. And so that's the January chart. When you look at March, same thing here. Again, best case scenario is this spread goes 20 to 25 under. I'd love to say it's going to go out to 35 under. But the one thing I do know is that the funds are aggressively adding 100% of their position into January. So at some point, like Kip just referenced, they're either going to have to roll their position into March, or they're going to have to liquidate their January short position outright, or a combination of the two. So, this is where, from an industry standpoint, know what you're selling, know what you're buying. Look, you can say that January is a sell and you're in good company with the funds, but the second they let up off the throttle,
Look out.
You're going to have this big void in this chart to get to the point where it makes sense for commercials to either liquidate their longs and or to see new commercial selling come back in. Commercials are going to be more than happy to replace the funds on any rally, but commercials are not going to chase the funds to the downside here, because when this fails, if this fails, and there's a high probability it will, the funds are going to be the catalyst, just like they're the catalyst down, they're going to be the equal or greater catalyst back to the upside here. And I'm going to, on that note, guys, I'm going to jump off. Mike, I just sent you the slide deck if you want to reference it at all.
Oh, perfect.
It's just the basis stuff.
Yeah, actually, you know what? I think
See you, Greg.
we'll
good.
wrap
I
that
appreciate
up. You know what? Maybe Kip and I'll give the kind of
I appreciate it, guys. We'll talk soon.
Okay.
Thanks, everybody. Take care.
Yeah, no worries.
Yeah. So Kip, I think what we just talked about, or what Greg just talked about, we're kind of sitting on a powder keg here for sure. When it's not the industry short, it is fast money short, and what you just referenced, the supply has no interest in increasing production at these levels or even lower. So to move lower is going to take significant force. To move higher could happen rapidly.
Well, and I think we are somewhat getting a little more sophisticated, especially I think with the new contract. And if you're a multifamily guy, let's just say we go to 400 or 350. If you are not covering the maximum amount that you possibly can, you're out to lunch. There's no way that there's any multifamily business like ahead of us in the next, which is going to be substantial because of rents and everything. There's no way they're using $400. They're probably using $700 or $800 from their contractor. And so if you can cover it 50%, like you would be crazy not to. I mean, our industry is consolidating. We were the top 30 guys were 50% 5 years ago of all of our production. They're now 2/3. Their ability to ratchet production up and down is quite a bit greater than it was, and it'll continue to consolidate. And they're making better decisions as opposed to I am the low cost guy and I'm going to run and you're going to shut down. Those days are kind of over. They're now managing. Look at OSB. When's the last time OSB actually sold at a loss to the OSB mills? There's only four of them. They ratchet it up and ratchet it down, but they don't lose money making OSB.
That's a great point. Here we've got an amazing comment here. This is from David Stalkop, and I wish I could show it all. So he was talking about the Asian market, New Zealand selling fumigated rough green, equal to $278 per thousand board feet in Southeast Asia. The rest of the comment is, I'm sorry, I'm sorry. The buyers there would absolutely switch to SPF in a heartbeat as soon as they see 250 per thousand board feet FOB Vancouver port, especially on 2x8 and wider. So look, everything's pointing to we're closer to a low point.
The bids are coming in, starting to come in from China. Of course, they're low, but they've also paid a lot more than 250, right? So like the bids are starting to come in, and at some point, if they can't get enough, which we do have a global wood shortage, and the other thing I think is there's a chance the Europeans, this year is going to be about 2.3 billion shipping to the US on a 60 billion foot market, with the spruce beetle thing kind of rushing through, and it's kind of use it or lose it. There's a chance we get less wood from Europe next year and more goes to China, as it has in the past.
Yeah, there's
a very good chance of it.
There's a chance we just get less wood from Europe being made because the energy costs over there are so darn high.
Well, that has something to do with it as well.
Yeah. So I think if today wasn't November 15th, if today was January 1st, there would be a lot more PO books sitting out in front of buyers, and they'd be a little more active.
Everyone thinks the single family housing market's going to be zero Jan, Feb, March, and I happen to think it's not going to be zero. It's going to be way off, but way off. If you don't have any inventory, way off's a lot. And everyone I talk to is somewhere between 15 to 25% less than last year at the same time. And that's a big drop.
We talk about a multifamily building. And it's a rental type structure. I mean, there is a new financial vehicle that has, I say new, there's interest in buying single family homes for rent. So as opposed to
own or rent.
Right. So as opposed to building a multifamily unit, what if I build a multifamily development? In other words, KB Home comes in, puts up 1,000 homes, and Blackstone walks in and buys them all.
And it's exactly what's happened. It's exactly what's happened. We'll take the whole subdivision, and they have way more money, obviously, than anyone else. Right. And we're just going to take those 500, and we're going to rent them out. And in 10 years, we might sell them. But in the meantime, the rent more than pays for, the cost.
Now, they're not going to pay today's price. They're going to pay a discount for sure on the actual structure. But with rising rents, that puts into the financial calculation around a rental unit that it makes sense, even with interest rates where they're at, to build a unit and rent it as opposed to park your money into a 5-year CD, if you would.
It's in Vancouver. I mean, Vancouver's a little bit of a different real estate market. I get that. But in Vancouver, if you rent a house and do not buy the exact same house, your cap rate is somewhere around 1.3%. So if you are doing the math, you would be much better to rent a house in Vancouver and take that money that you would have spent and invest it, and hopefully you can make more than 1.3%.
Oh, that's interesting.
You're actually kind of stupid to buy a house in Vancouver today. The rent is so much cheaper.
Very, very
$3 million house costs you $6,000 a month. You want to rent that house every single time.
So look, let's kind of wrap up my thoughts here. The knowns are out there. Interest rates are what they are. Inflation is what it is. The unknowns are, how much supply will come off as we go lower, and how much more demand can we mine out there? Like, is the China demand really going to come in? Potentially. Are interest rates done going down? Are the Wall Street buyers going to be underpin the market? So there's
a couple things. I mean, and we talked about it, right? If the 10-year Treasury, the regular premium for the 30-year fix, we would be somewhere in the low fives. I mean, obviously interest rates have been going up so quickly, that's not there. But you would have a less than 5.5 would be over the last 30 years. That's where mortgage rates would be today. And if that does, you got to think it's going to start coming reversion to the mean. And, are we going to have way more lumber available? Well, we've had less this year than last year. Total North America. Doesn't matter where it comes from. So, we're already kind of declining a little bit. I do not think $400 lumber is the price in the first 6 months of next year. It could be $100 more, 150. I don't know. It's not going to be $400. I honestly believe that.
Now, all things, we sound rather bullish on lumber. We very easily could go sideways from here. Like, if things stay calm, if nothing changes, absent of outside influence, we could just stay here at these levels and go sideways.
We could have our usual, I mean, we've talked about it before, our $130, $150 range for the year. 2019, I believe it was $130.
Yeah.
It's possible. But my comment is the 400 is not the top. So if we have a $130 range, it's 400 to 525, whatever.
All right, we're gonna wrap it up. Kip, that's great to have you here. Thanks so much. We appreciate the comments coming from the West Coast, especially with the kind of new China news bubbling to the surface. We hope to see you here again soon.
Yeah, absolutely. Appreciate it. Thanks for having me on.
No problem. All right, everybody, take care. We'll see you next Tuesday. Bye-bye.